Have you ever wondered what gives the US dollar its power? For decades, it's been the world's financial backbone. But with geopolitical tensions rising, major economies like China and Russia making deals in their own currencies, and new digital money on the horizon, the ground beneath the global financial system is starting to shift. Is the world witnessing the beginning of the end for the dollar's reign? Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're unpacking one of the most significant economic shifts of our time, de-dollarization. To understand why this matters now, we need to grasp just how dominant the dollar has become. Even today, the US dollar accounts for nearly 60% of all global foreign exchange reserves and is used in over 80% of international trade invoicing. It's the currency of oil, of debt, and of global finance. However, subtle but significant cracks are beginning to appear in this foundation. We're seeing countries like China actively reducing their holdings of US Treasury bonds. Nations are forging bilateral agreements to trade in their own currencies, bypassing the dollar entirely. This isn't just a theoretical discussion anymore. It's happening in real time, driven by a desire to reduce dependence on a single nation's economic policy and geopolitical leverage. This growing trend forces us to ask a provocative question. Is the world witnessing the beginning of the end for the US dollar's reign? To truly appreciate the gravity of this potential shift, we must look back at how the dollar ascended to its throne. Its story begins in the aftermath of World War II, a period of unprecedented global rebuilding. In 1944, leaders from 44 Allied nations gathered in Bretton Woods, New Hampshire, to design a new international economic order. Their goal was to prevent the kind of economic instability that had contributed to two world wars. The solution was the Bretton Woods system, which pegged global currencies to the US dollar, and the dollar, in turn, was convertible to gold at a fixed rate of $35 per ounce. This arrangement made the US dollar the world's undisputed anchor currency. This system held for nearly 3 decades, but a pivotal moment arrived in 1971. Facing economic pressures, including the costs of the Vietnam War and a dwindling gold supply, President Richard Nixon announced the Nixon shock, unilaterally ending the direct convertibility of the US dollar to gold. The world's currencies were suddenly floating freely, and the dollar became a fiat currency, backed only by the full faith and credit of the US government. Yet, despite losing its golden anchor, the dollar's dominance only grew. Why 2 words? Trust and liquidity. The US had the largest, most stable economy and the deepest, most liquid financial markets. For the rest of the world, there was simply no viable alternative. So, what exactly do we mean by de-dollarization? It's a term you're hearing more and more, but it's often misunderstood. At its core, de-dollarization is the process by which countries actively reduce their dependence on the US dollar across 4 key areas: international trade, financial transactions, foreign exchange reserves, and cross-border debt. It's important to understand that this isn't necessarily a single, coordinated anti-US movement. Instead, it's a multifaceted trend with different motivations. We can break it down into 3 distinct categories. First, there's official de-dollarization, which involves deliberate government-led policy shifts to move away from the dollar. Second is natural diversification, a more gradual process where central banks and investors slowly rebalance their portfolios to include other currencies and assets, simply as a matter of prudent financial management. Finally, there's de-risking, which is a direct response to the perceived weaponization of the dollar through sanctions. Countries seek to insulate themselves from potential financial punishment by creating alternative systems. This is happening through various mechanisms, from invoicing major commodities like oil in local currencies to increasing national gold reserves. We're also seeing the development of alternative payment systems like China's cross-border interbank payment system (CIPS) or the mBridge project, which uses blockchain to facilitate multi-country digital currency transactions. This brings us to the core drivers. Why are so many countries exploring a move away from the dollar now? The motivations are a complex mix of geopolitical strategy, economic necessity, and technological innovation. The most potent driver is undoubtedly geopolitical. The United States' use of financial sanctions as a primary foreign policy tool has demonstrated to the world that access to the dollar-based system is a privilege, not a right, for nations like Russia, Iran, and increasingly, China. This has turned into a powerful incentive to build a parallel financial architecture that is immune to US influence. They see it as a matter of national sovereignty. Economically, many nations, particularly in the developing world, want to reduce their exposure to U.S. monetary policy. When the Federal Reserve raises interest rates, it strengthens the dollar, making it more expensive for these countries to service their dollar-denominated debt and pay for essential imports. By trading in local currencies, they hope to insulate their economies from this external volatility. Furthermore, rising economic powers like the BRICS nations Brazil, Russia, India, China, and South Africa, along with blocs like ASEAN and the Gulf states, are asserting their growing influence on the world stage. Promoting their own currencies for trade and finance is a natural extension of their rising economic weight. Finally, technology is the great enabler. For the first time in history, alternatives are becoming truly feasible thanks to central bank. Digital currencies, CBDCs, and blockchain-based settlement platforms, which offer a potential path to faster, cheaper, and more direct cross-border payments without ever touching the traditional banking system. These aren't just abstract ideas. De-dollarization is happening on the ground. Let's look at some real-world case studies. The partnership between China and Russia is perhaps the most prominent example. Following the sweeping sanctions imposed after the 2022 invasion of Ukraine, the two nations dramatically increased their use of the yuan and ruble for bilateral trade, especially for crucial energy transactions. This shift was born of necessity, but has now become a strategic priority. Elsewhere, India and the United Arab Emirates have signed a landmark agreement to settle trade, including energy imports, using the Indian rupee and the UAE. This move helps both countries reduce transaction costs and bypass dollar dependency. On a larger scale, the BRICS New Development Bank is actively working to provide financing for infrastructure projects in member countries denominated in local currencies, creating a direct alternative to the World Bank and IMF, where the dollar is king. The data backs this up. According to the International Monetary Fund, the U.S. dollar's share of global reserves has been on a slow but steady decline, falling from over 70% in the year 2000 to approximately 58% today. This isn't a collapse, but it's a clear and undeniable trend. So, what happens if this trend accelerates? The impacts and risks would be profound, not just for the United States, but for the entire global economy. For the U.S., a significant decline in demand for the dollar could lead to higher borrowing costs. For decades, the world's hunger for dollars has allowed the U.S. government to run large deficits at low interest rates, a privilege no other country enjoys. Losing this would mean higher taxes, reduced government spending, or both. It would also diminish American geopolitical leverage, as the power to impose sanctions would be severely weakened. For global markets, the transition could be rocky. The current dollar-centric system provides immense liquidity and stability. A move toward a more fragmented multipolar currency system could introduce significant volatility and reduce overall market liquidity, making international finance more complex and potentially more fragile. Developing countries, while seeking to escape dollar dominance, could face new risks. Switching to less stable currencies could expose them to rampant inflation and exchange rate instability, if not managed carefully. For investors, this new landscape presents both opportunities for diversification into non-USD assets like gold or emerging market bonds, but also a great deal of uncertainty. Looking ahead, what might the future of the global financial order look like? A complete and sudden collapse of the dollar is highly unlikely. Instead, analysts envision three more realistic scenarios. The most probable outcome is a gradual erosion where the dollar remains the most important currency, but its dominance slowly wanes over the next 1 to 2 decades. It would still be first among equals, but no longer the sole hegemon. A second possibility is the emergence of a truly multipolar system, where a few major currencies, namely the US dollar, the euro, and the Chinese yuanco, exist as primary reserve assets. In this world, global trade and finance would be divided into currency blocks, with countries aligning based on their geopolitical and economic ties. A third scenario involves the rise of regional currency blocks, where groups like BRICS plus the Gulf Cooperation Council, or ASEAN, develop their own common settlement mechanisms, further fragmenting the global system. In all these scenarios, central bank digital currencies are a major wildcard, state-backed, programmable, and potentially borderless. CBDCs could radically disrupt the mechanics of international payments, accelerating the shift away from the traditional system. So, what are the key takeaways from all this? For policymakers around the world, the message is clear. Diversify reserves and build economic resilience to reduce vulnerability to external shocks and sanctions. For investors, this is a wake-up call to think globally. Hedging portfolios with non-USD assets, such as gold, other major currencies, commodities, and carefully selected emerging market bonds is becoming an increasingly prudent strategy. And for businesses engaged in international trade, it's crucial to monitor developments in cross-border payment technology and manage currency exposure more actively than ever before. To summarize, the trend of de-dollarization is real, but its progression is likely to be slow and evolutionary, not revolutionary. This shift is being driven by a powerful convergence of political will, economic self-interest, and technological advancement. And finally, the most likely outcome is not the crowning of a single new currency king, but the dawn of a more complex, multipolar financial world. Do you think the US dollar will still dominate 20 years from now? Let us know your thoughts below. And if you found this analysis valuable, please like this video, subscribe to our channel, and stay tuned for our next deep dive on the digital yuan and the future of global money.